How to avoid fakeouts. You are a beginner trader or you have been struggling with trading. You take really good A+ setups, you wait for those setups, you execute, but you still get faked out. You lose money, you don't know why, what's happening because you stuck to your strategy, but you still lost money. In this video, I will share my 5 years of experience and give you 5 ways with the help of which you will be able to detect and avoid fakeouts. This might actually be the most useful video I have ever created because this video can save you tons of money when trading and eventually put you green for the year. We will start this video with easy ways to avoid fakeouts, but towards the end of this video, it's gonna get a bit more complicated. So you gotta stick around for that. The first way to avoid fakeouts, the easiest way, is to focus on higher time frames. As I mentioned, it's one of the easiest way to avoid fakeouts. I see a lot of traders, whether you are beginner or advanced, they mark a lot of levels based on the 1 and the 5 minutes chart. Your game plan needs to be on the higher time frames. By higher time frame, I mean 1 hour chart and above. So personally, I mark my levels on the monthly chart, the weekly chart, the daily chart, and the 1 hour chart. I stop there and then execute based on the 1 and the 5 minutes chart. You can also incorporate 15 minutes chart based on your strategy, but don't mark your levels on the intraday time frames like the 1 and the 5 minutes chart. I'm going to give you guys a quick example to show you how I do my technical analysis and how I mark my levels. So I'm going to start with the monthly chart on AMD. We can see that we just need to mark our levels near the current price, guys. That is very important. Yes, I can mark my levels right here just for the sake of this video. I can mark my level right here, resistance right here. We can see on the monthly chart. Resistance turned into support, turned into support, turned into resistance again, support again. But this level is not important to us because as of now, AMD is holding near $150. So this level is very far away from the current price. So for this video, I'm going to mark this level, but you don't have to. Near the current price, we can see that the high of this month is near 164, which is still reachable around 150. Then that is pretty much it. I can mark the resistance right here, which has turned into support recently right here. So we can see high of this month coincides with the low of this month, low of this month. That is pretty much it. On the weekly chart, we can see the levels that we marked on the monthly chart coincide with the levels on the weekly chart. I can mark a few other levels on the weekly chart right here. We can see that this resistance turned into support right here, turned into support again. That is pretty much it. Only one level needed on the weekly chart because these levels already coincide with the weekly levels. You guys can see the level that we marked on the monthly chart acted as really strong support on the weekly chart right here. On the daily chart, let's see if we can mark a few more levels. I don't see any level. Basically, we are kind of making a bull flag on the daily chart. So I can mark a channel right here. But yeah, I don't see any more levels on the daily chart. Basically, maybe we can mark this level. We had a few low of the days right here. So if we get above 153, we might go for the breakout of this bull flag. But yeah, we can't mark a lot of levels on the daily chart. I'm pretty sure we won't be able to find any more levels on the 1 hour chart as well. But you guys can see the levels that we marked on the higher time frames, like the monthly, the weekly, and the daily. These levels coincide with the time frame on the 1 hour chart as well. Support right here, support right here, support right here, support right here, resistance right here, resistance right here, right? So these levels are pretty important on the 1 hour chart as well. But yeah, I don't think so we need any more levels, and that is pretty much it. I marked 1, 2, 3, 4 levels, and if I remove the levels that are far away from the current price, basically I only have 2 or 3 levels to play around with. So as day trader, I'm going to wait for the price action to come near these levels for me to take a trade or not. And that is how you avoid fakeouts. Yes, this stock might make an intraday level near 152, but you don't have to trade that level. Wait for the stock to come near the levels that you're watching on the higher time frames and then look for breakouts or rejections depending on your strategy. And also a few other important levels are the yesterday's high, the yesterday's low, 2 days ago high and 2 days ago low, pre-market high and pre-market low, weekly high and weekly low. I actually made a video on the day trading indicators I use. That video also includes these levels and the importance of these levels. So I'm going to link that video towards the end of this video. And now the second way you can avoid a fake out is by focusing on volume. I am personally a tape reader. I focus on the tape a lot, the market sentiment on the tape, which is actually a separate point we are going to talk about later in this video. But tape reading takes time and experience. It takes a lot of time. It gets better with experience. But focusing on volume is pretty straightforward. You can focus on volume and avoid a lot of fake outs in the process. So what do you mean by focusing on volume? So just basics of price action. Big candles should be on high volume, small candles should be on low volume. You don't want to see a lot of volume being done on indecisive candles. So just the basics of price action. I'm going to give you guys a few examples. So for example, if you have a big candle right here with big body and small wicks, that candle needs to be ideally on high volume. If you see that candle is on low volume, that means yes, buyers or sellers won, but that was on fairly low volume, which is called a volume anomaly. That means something out of the ordinary is happening and you need to focus on that. Now let's take an example of a doji, which is also called indecisive candle with very small body and big wicks. If this candle is on low volume, that honestly doesn't mean a lot. It might still continue the push towards the upside or downside in the direction of the trend. But if the same candle is on high volume, that might be a sign of reversal. Same thing, if you see an uptrend, if the stock is going towards the upside, suddenly you see a candle with very high volume. That is called exhaustion volume. That might be the end of the uptrend. So if you're thinking of taking it long right here, don't take it, focusing on volume. Now, one last example, which is pretty straightforward. If you have a stock in an uptrend right here, stock is going towards the upside right here. You're looking for a long position on a pullback and you see a pullback right here. So this is the pullback. Maybe it's making a bull flag. You want this consolidation to be on low volume. So that means the stock went up on high volume and then you want the consolidation to be on low volume. If this consolidation is on high volume, maybe even higher than the push towards the upside, that might actually be a reversal and not a pullback. So if you were thinking of taking it long right here on the pullback, it might actually be a reversal and continue the push towards the downside. And that's how you can use volume analysis to avoid fakeouts. Honestly, I just touched the tip of the iceberg in this video because there's a lot more to volume analysis than I can cover in this video. One book I can recommend you guys is Complete Guide to Volume Price Analysis by Anna Cooling. It's a really good book. And if you guys want me to make a separate video on just volume analysis, it might be 15, 20, even 30 minutes long. Let me know in the comment section below. The third way you can avoid a fakeout is by focusing on the overall market sentiment. I'm giving you guys my secret to consistency in this video by discussing these 5 ways to avoid fakeouts, and the only thing I ask in return is to like and subscribe because it helps out the channel a lot. Do it now. So what do I mean by overall market sentiment? So let's take an example. If you're trading a tech sector stock like Tesla, Nvidia or Meta and you're taking it towards the upside, you have to focus on the tech sector and SPY, which tracks the overall US market. You need to watch QQQ, which is the Nasdaq, and you want to watch SPY, which is the S&P 500. So if you are taking a tech sector stock like Nvidia towards the upside, but QQQ, which is the Nasdaq, it's going towards the downside, that means the overall market sentiment is bearish and it's not supporting your position towards the upside. So if a tech sector stock like Nvidia or Tesla or Meta is going towards the upside, but QQQ is going towards the downside, that increases the chances of you getting faked out on that upside position. There's a very easy way to understand this, and I hope you guys have ridden a bike before. So this is you riding a bike. In this case, you're riding your position. So you are sitting on the bike and you're riding a position, say on NVDA. You're taking NVDA towards the maybe upside. And now the market sentiment is like the wind. So if you're facing tailwind, that means the wind is in the direction of your position. That means you're going in this direction and the wind is supporting you. That means you're facing tailwind from the market. It's very easy for your position to work out the way you want it to. On the other hand, if you're facing headwind from the market, that means the market, you're taking a trade towards the upside on the tech sector stock, but QQQ, that means the overall market sentiment is bearish. That means you're facing headwind from the market. In this case, the chances of you getting faked out are exponentially higher than the first case. Now, there's an exception to this concept, and the exception is that if the stock you are trading has some sort of news catalyst, maybe earnings, maybe CEO change or whatever, upgrade, downgrade, and it has a lot of volume, very, very high volume compared to the average volume, that makes the stock independent of the overall market. You might have realized this, that maybe the tech sector is weak, but Nvidia reported earnings, the stock is gapping up, it's really strong. It doesn't give two shits about what the overall market is doing. So in that case, you don't necessarily have to focus on the overall market sentiment, and that is the only exception if the stock has some sort of news catalyst. Now, the fourth way you can avoid a fake out is to avoid trading during or just before major economic events. This is very important, and to understand this point, you first need to understand that you can't move the market as a retail trader. You don't have any power over what the market does. I don't care what market you trade, whether it's futures market, stock market, crypto market, you can't move the market market as a small fish. You are just a small fish in the ocean, and the market is created. The waves in the ocean are created by the whales. These are the big money players like the banks, the institutions, the hedge funds. They create the waves in the market, and your job as a small fish is to join them, join the wave, make your money, and be done with it. And also you need to understand that during or just before major economic events, the whales are chilling by the seashore. So there are no whales in the sea to create the waves. And if the waves are not there, it's going to be 10 times difficult for you as a small fish to make money in the market to go from point A to point B. And to explain this point, let's take an example of NVIDIA recently. So if you guys watched my last video, which was on the strategies I used to make money, this was actually a playbook setup based on the technicals. We had a push towards the upside, daily range consolidation, flags, triangles on higher time frames. We made a daily range right here. On Monday this week, I was watching this stock for a push towards the upside. It did not work out. I made small amount of money on this trade. Why? Because this stock is reporting earnings on Wednesday after market close. So the whales, the big money players, are waiting for the earnings. They are not trading. If you want to see a good push towards the upside, the volume needs to increase. The volume needs to be high like these candles right here. The volume did not go up. Why? Because the whales are chilling by the seashore. And that's why this was actually a fake out. And you could have avoided this fake out by not trading during or before major economic events, earnings in this case. Now, the fifth way you can avoid a fake out is by focusing on the tape. This is the most difficult point, and I saved it for the last because tape reading comes with screen time and experience. You need to get hours, hundreds of hours, thousands of hours of screen time, years of experience to get better at tape reading. Personally, I am a good tape reader. I look at the tape of stocks like Tesla, NVIDIA, Meta. I'm fairly confident with these stocks because every stock has different personality. I'm very well aware of the fact that I'm not very good at tape reading NYSE stocks. Like if I trade stocks like Shopify or Snowflake, I lose a lot of money on these stocks because I'm not able to understand the sentiment on the tape on these NYSE stocks. And the reason is because I have spent thousands of hours in the past 5 years looking at the tape of these stocks like Tesla, NVIDIA, Meta, AMD, and I haven't spent a lot of time looking at the stocks like Snowflake and Shopify, and that's why I'm good with tape reading on the Nasdaq stocks compared to the NYSE stocks. So as I mentioned, tape reading gets better with screen time and experience. There's no easy way to go about it. There's no replacement for experience, but one way you can multiply your screen time is by recording your screens every single day. Whenever I say this to any new trader, the reaction is like, do you want me to watch the recording 2 hours every single day? No, you have to record your screen every single day when you are trading actually, and then you have to watch the recording again only when the stock gets near your levels. So for example, you were watching $200 level on Tesla. You don't need to watch the tape when Tesla is holding near 196, 197. No. Just skip to the recording part where Tesla is actually trading around $200 and look for successful breakouts and fake outs and look at the difference between the two. So cut the part of the video when Tesla was actually a successful breakout, compare that with a fake out, and then you will know what is the difference in the tape reading between these two scenarios. Yes, it takes time. It's not easy, but it's not supposed to be easy. As I always say, if it was easy, everyone would be trading for a living. If you want to be in the top 10 or 20% of the traders in the world, you need to do these few extra steps that separates you from unsuccessful traders. And I'm the first one to admit it that tape reading is not easy. It takes a lot of time. It takes a lot of experience because you don't know what to look for. Once you know what to look for, then you can look at the recordings. And that's why in our mentorship program called the Summit, we have 2 dedicated classes to tape reading. So if you guys want to join the waitlist of our mentorship program, the link will be in the description box below. And that is pretty much it for this video. If you have any questions for me, let me know in the comment section below. If you guys don't follow me on Instagram, I post a lot of good behind the scenes trade recaps of a trader on Instagram as well. The link will be in the description box below. Like and subscribe this video. Thank you for watching, and I will see you guys in the next one.